If you're a long-term investor, you want to identify companies that will be around for the long haul. And if the market experiences another drop, you want your stock to recover as soon as possible. And from my experience, the kind of company that is good for the long haul and the kind of company that will rebound quickly from a correction is a company with major free cash flow. So let's take a look. Free cash flow is the cash flow available to a company. It can be used to repay creditors. It can be used to pay dividends. And it can be used to pay interest to investors. In fact, many investors prefer to pay attention to free cash flow rather than earnings per share as a measure of a company's profitability. Revenues and earnings are both significant to a company, but both can be easily manipulated. As an example, earnings can be skewed by corporate buybacks, which reduces the share count and ultimately will appear to improve the earnings per share. Unlike revenue and earnings, cash flow can't be manipulated. And a company with a good free cash flow is more likely to make dividend payments, acquisitions, or can make buybacks if it wants to. The more free cash flow a company has, the more options the company has, and the safer it may be. As this table shows, the 5 companies with monster free cash flow include Apple, Verizon, Microsoft, Walmart, and Pfizer. All 5 of these companies are household names, and all 5 of these companies have been consistently profitable. However, not all of them have delivered consistent revenue growth. Remember, while free cash flow is an important metric, it's still only one of many metrics. So conduct your due diligence. The best company on the list is likely Microsoft. However, Pfizer is the most unloved of the 5. Pfizer's chart shows it has the most upside potential, at least in my opinion. So let's take a look at Pfizer on our charts. And this is the 20-year monthly chart on Pfizer, and the symbol is PFE. For disclosure purposes, I do not hold any shares of Pfizer at this time. And the important thing to take a look at in the price chart was the bottom there in 2009, and subsequent to that, we've had a very strong rally all the way up through here, with the exception of this contraction that started there in late 2018, contracted down here, but looks like it bottomed and based here, and it's on its way up. Moving into the volume, that looks fine. And you can see here, again, in the MAC, the top there in late 2018, the contraction, and now the bottoming and basing that's occurring right here. Both the fast line and the slow line are below the zero line, but they're well within reach, and the bottoming looks like it's occurring right now. I would imagine that the fast line is going to move through the slow line soon enough, and both will be above the zero line also relatively soon. Here in the histogram, you can see the bottoming and basing here with the improvement in the last several months on its way up to that zero line. Again, price rate of change, nice bottoming and basing with the fast line popping through that slow line, both of them on their way up to the zero line. You're going to see similar patterns here in the relative strength index, which is at 52.59, above that 50 or midline, basing and on its way up. Same thing here in the stochastics, as well as into the Williams. The Williams, nice basing bottoming there, popped right up through here. It's almost into the overbought territory, not quite yet, but it'll be there soon enough. And if it does, it's going to pull the other oscillators up as well. Back here to the price chart, one last look, and as usual, conduct your due diligence, study the fundamentals. And for today, that's ChewDog Charts. Thank you.